One of the most important ways of measuring whether a company is going to be successful as an investment or not is using fundamental ratios. Fundamental ratios allow us to compare smaller companies with larger companies. For example, one company might have earnings per share of $1, another company may have earnings per share of $2, but it doesn't mean that one company is better than another. But when we look at ratios, then we can actually compare companies, as I just said. And the most important ratio is definitely return on equity. It's really a scorecard for management. It's a scorecard for how well management is running that business. Return on equity is the profit of the business divided by the equity of the business. In other words, it's the total money that the business earns after paying all taxes and expenses divided by the money, in a sense, that management has available to it, that is the equity. So it's not a measure of share price, it's a measurement of management's ability. If a company only has a return on equity of 5%, say, or less, then actually that's the most that you can make from that investment over time. In fact, on the ASX, 2/3 of the companies don't even have any return on equity because they've either got no profit or actually losing shareholders' money. So for a start, we look for companies with return on equity of at least 10%, but preferably 15% or 20% or higher. Every year in the annual report of Berkshire Hathaway, Warren Buffett says that he looks for companies with high return on equity and little or no debt. And that's the other way that companies can actually artificially juice up their return on equity. That is, they don't just increase the profit, but they lower the equity. And they can lower the equity by taking on extra debt. So quite simply, we like those companies that Buffett likes, high return on equity and little or no debt.